Okay, so previously I was trying to start this video talking about making a cross-correlation dashboard or a model for U.S. equity indices using cross-asset correlations, which is nice because they're not traditional indicators. They use minimal parameters, if any. And it's not crazy macro stuff. It's not like interest rates and yield curve. It's more just like the VIX term structure. So the options, values, and products derived from the options on the S&P 500 index, and credit spreads, which are the closest to macro you would get here, breadth, which are companies inside of the index, and then VIX, volatility of VIX. It's not that complicated, actually. It doesn't really involve interest rates or anything crazy. In the last video, I was trying to start it by just breaking it down and starting with the VIX term structure. But I kept talking for a long time. Basically, this dashboard should be able to tell you, like, if you're a swing trader, like, just absolutely beautiful, very principled entries for the S&P 500. If you're trading a retirement account and you can only do, long only, it can tell you when to deploy capital. If you're a scalper, it can tell you a directional bias for the day. But it starts out basic, and it gets, when you layer everything on, it can get just like uncannily accurate. Sometimes it might be, a few days early or late, but in the scheme of things, it allows you to capture really big swings. Anyway, I'm going to jump into VIX term structure. I'm not going to explain too much what VIX is, because there's a lot of information on that. I'm going to put up notes. There's a white paper on how VIX is calculated. And just real quickly, this is VIX, the index. This is the S&P 500 on a daily basis. So not too crazy. You can see they're basically inversely correlated. Really, and why is that? We can get into that, but maybe not. So there are these white papers on VIX. It literally tells you just the step-by-step instructions. If I had to explain it in my own words, I would just say you take the entire options chain for the S&P 500 index, you weight it so it's as close to 30 days as possible. So if you're like in between 30 days, you use, half weight on the first expiration, half weight on the second expiration. If you're right at 30 days, then you use 100% the second expiration. You only use liquid strikes. I don't think there's much more to it than that, but basically it's like, hey, what's the weighted implied volatility across the entire S&P 500 using targeting 30 days out? There may be other little caveats in there. There's a nice neat formula here you can look at, and like nowadays you can just plug this into ChatGPT and figure it out. Like I guess it's weighting by how far away the strike is. So if it's really out of the money, maybe it weights it less, or maybe it weights it more. I don't know. That wouldn't really make sense, would it? Like it's weighting it by time, so if there's a lot of time, it will de-weight it. Or maybe this is a minus term, so maybe it's actually doing the opposite of that. Anyway, you can look it up. You can plug it into ChatGPT. The important thing is you can't trade this. You can't buy here and sell here and make 77%. That doesn't make sense. This is just an abstract number that represents the implied volatility of the S&P 500. It's pretty convenient because you can also extrapolate, like you can say, hey, this represents the percentage move annualized of the S&P 500 within, based on the 30 days options. So like right here during Liberation Day, it was saying, hey, we're going to move 40%. We don't know if it's up or down, but we're going to move 40% from here. That's what the options were pricing. So like right here, 40% down. Ooh. It's not really on this screen, but %40 down. Wow. It was saying, hey, we're going to move back to 3,000, or maybe we move up. It's not actually equivalent up or down because usually the puts have more implied volatility than the calls, or the puts are more expensive than the calls because people care more about hedging the downside than punting on the upside. You can't trade it, but what can you trade? You can trade, that's not it, this one. Oh, maybe I did select, I did select, okay, this is a future, you can trade this. If you type in VIX, this is the index, this you can't trade, this is just an indicator. So like on Liberation Day, it opened up at 60. On the yen carry trade blowout, it went up to 60 or something. COVID, it went up to 100 or fucking whatever. Anyway, so that's that. Then you have VX1, and this is less. Well, why is it less? It's because this is the real value that people are trading. This is a future. You can buy and sell as it shows here, for God's sake. So yeah, the future never really totally approaches the value of the index. And Robot James has a great write-up on this. He also has a better write-up about it on like robotjames.com or something. But basically these are links that can help you understand VIX. There's tons and tons of resources on it, so I won't even get into it. Anyway, what's the important part? This is the important part here. This is the VIX term structure. So this is the future expiring in July. This is the future expiring in August. This is the future expiring in September. The steepness or flatness of this curve tells you how stressed out the market is. So like, why is August worth more than July? Because there's more uncertainty from now to August. Why does it dip into December? I'm not really sure, actually. There could be various explanations for this. It could be based on, like, hey, the volume, the open interest, like maybe these aren't traded very much. Maybe it's because, hey, the tariffs have a 90-day window on them, so this is when we'll decide on the tariffs, and then after that it will be here. Like, I don't know. There was a really interesting term structure during the, oh yes, this is 2008. Look, the front end is higher than the back end. Usually in normal futures, hang on, let's go to bar charts. We're going to go totally basic here. Bar charts term structure. Can we do that? bar chart oil futures. Okay. Okay, so yeah. Here's oil. Right now, oil is popping off because it's the Iran and Israel are firing missiles at each other. Here's July 25. It's 74. Here's Jan 26. It's 67. Why is oil more expensive now than it is in the future? Usually for financial instruments, the further out you go in time, hang on, bar chart gold. Yeah. Okay, so here's gold. Now it's 339 or 3,390. It's 3.3. Here it's 3.5. Why is that? It's because there's an interest rate. If you have to borrow money to hold these things, there's an interest rate. There's storage. For gold, there's storage. You have to put it somewhere. There's fees for that, so that gets baked into the price. The further out you go, the more expensive it is. That's something like normal, and like ES is kind of like that. Not so for oil, because it's like right now people are like, oh man, we don't know what's going to happen tomorrow. Someone could launch nukes, the US could enter the war. We don't know what's going to happen, so I want my oil now. So this oil is more in demand than this oil. And yeah, in futures it's called backwardation and contango. Contango is normal, where the future is more expensive than the present. Backwardation is the present is more expensive than the future. We could see this in oil. I think it was in copper, like in the last year. Also in cocoa and coffee. You can just plot these curves over time and look at them, and they kind of indicate like, hey, is it in high demand or is it not? Or is there too much supply and it costs money to hold it? That's the best way I have of explaining it. But basically, here's VIX now. It's actually relatively normal, surprisingly. Historical prices, we can look at last year going into the election. Oh, come on. Come the fuck on that. Okay, yeah, so this was last year. Let's say it's October 10th. In 1 month we have an election. Our volatility was way up here, then the election was... Oh wait, are these showing weeklies? Oh no, these are showing days to expiration. So 40 days to expirations, that's like after the election. Yeah, this was just a weird term structure. Yeah, so it looked like this. Like, hey, in August, in 2 months you have an election. In 62 days, 2 months, here's the volatility. It's 18. It's implying a 18% move annualized in the S&P 500. Then it goes down. Then it goes up. So this is like, god damn. It's relatively in that it's relatively normal in that it's sloping up, but it's also weird in that it's got a big lump in it. That was last year during the election. Let's go back another month. Last year during the election. Okay, and then oh shit, actually here would have been the yen carry trade blowout. I guess it didn't have that much impact after all. Here. Oh, there we go. This was the yen carry trade blowout. Suddenly you're at 20 VIX, which seems normal now. Then, just for comparison, here's COVID. Wait, let's go January 2020. Well, back in the good old days, right? Hey, normal. 14%. That's like what the S&P 500 is supposed to return in a year, right? Goes up with time because it's more uncertain. Okay, let's look at February. Pretty much the same. Late February. Uh-oh. So this is actually like, I think it's stuff started going to shit. When did it go to shit? It was February 19th. It started going down. Boom, it really broke. Yeah, Monday the 24th. So, yeah. Anyway, I'm not going to go too in-depth on this, but the point is, hey, this looked normal. When could you start getting a heads up that things were like, hey, this ticked up, but it's still a normal slope? The next Monday, over the weekend, now it's backwardated. So basically now this is giving you a heads up. So as soon as this date, you could have known maybe it's not great to be long here, and then you had this. But anyway, that's just one example, right? But this whole site is for free. It has historical stuff. It's an easy way to visualize it. It's fair enough to like add this into your routine of just, you know, checking the term structure. And like now it's normal, so it's like, hey, let's just be long. But anyway, down here, I can plot the front month minus the back month. So if everything is just chill, it should be negative. If it goes over 0, that means it's flat or starting to backwardate. These big dislocations are probably, you know, rollovers, so I could try plotting something like this. Nah, it doesn't work. Just going to put a horizontal line at 0 so we can understand a little bit better. Okay, so, these aren't syncing. Okay, yeah, so here's 2009. It went way positive. Oh, this is minus, so it's like, hey, the back month is pricing in 15% more move than the front month. But the front month is pricing in 15% more move than the back month. That's pretty insane. Like you think that I'm not going to try to put it into words, but it's like in September you think, hey, the S&P 500 is going to move 30%. And then in September futures you think, hey, it's only going to move 15%. That doesn't really make sense. And it's kind of a sign of stress. It's just, yeah, the market's going down. People need hedges. They're buying the front month VIX because that's the most liquid. They don't need it for long. They just need it immediately. And then you have it go below 0. That's kind of an indication of normalization. But it didn't last for long. It went back up above 0. Let's just zoom in on this. 2009. That's, I don't even know how much of this is in our data, but then at this point, here's the literal bottom. March 2009. Wow, what a time to be alive, right? When you're in the moment, it feels much different. You have no idea that, hey, this is what's happening. Like, this is peak Armageddon. But it was significantly over 0 still. It didn't really go below 0 and stay below 0 for more than a few days. Like here, it's below zero for a few days, and you had this little tiny bit here. But then you have this. So it's like, here's our thing. We just want to, our edge is we're trying to buy when everything is going to shit and people are just panic selling. And we're providing liquidity, we're warehousing risk, or whatever, we're just perma-bulls, and we want to enter at the best time possible. This VIX term structure alone wouldn't really tell you, like, here. Like, if you're just using the value by itself, you'd be like, okay, sell here, buy here, sell here, really sell here, buy here, sell here, buy here, sell here, buy here. But it's like, once you've figured out, hey, you put it together with the news and the sentiment and some other indicators that we'll look at in other videos. How do you get this? How do you get this entry and then just walk away and not look at your account for a couple of years? You would want it to basically have done something like this and then be under zero for like a week or something. Hey, then you can buy here. Great. Do, whatever. Boom. You never have to look at your account again. You can look at other spots where where this term structure works. Like, hey, well, we were recovering from the GFC. You know, the market has little mini sell-offs, and the term structure goes positive or backwardated. Then it reverts like multiple times. Would you want to sell or take profit here? I don't know. It depends on you, and this isn't like a rigorous, like, formulaic thing. It's more like, here's 3 or 4 indicators. Good luck. You know, do something when 2 or 3 of them are in alignment. Yeah, here you got another sell-off. This one was pretty steep. Is it ever under zero for more than a week? I don't know. Finally here you get like a pretty steep decline. That could be your sign, like, oh wow, it just went back into contango. Interestingly, it's doing at the same time, as the market's going down. It's like, I feel like these things should be opposite. Like, when the market is going down, the VIX term structure goes up, right? So then when you have this is really interesting. It's going down and the market isn't moving. This is amazing. Like, if you're more of an intraday trader, this could be like an amazing setup or something. But this is showing the market is normalizing. You do have, I think these big dislocations are maybe expiration or something. So that's something we need to figure out, but it's still below zero, which is, you know, fair. So maybe you get long anywhere in here, and that's a decent entry here and here. Then here, the market's going down. Term structure is backwardated. It doesn't go back below zero for a while. Here, there's an expiration or something in play. You would have been kind of late to like, hey, I'm going to get this, but hey, you could get this. These are one-day bars, so it's kind of like really simple to look at it in hindsight. But it's, you know, in reality, it looks like this, right? Oh my god, the market's shitting. Oh no, backwardated VIX. Oh no, it's going higher. Oh, we're gonna die. Oh no, it's never gonna go to contango again. We're dead. Oh, now it's back in contango. You've already had this rally. Wow, 100 points or something. Actually, 100 points is quite a lot when the VIX is 1,000 is like 10% move. It's insane. Oh my god. Holy shit. It's like unthinkable when you're in the moment, but okay, do you buy here now just because it went below zero? Hey, there's multiple days going by. It's November. Eventually you go into the holidays, but like, okay, so this is kind of normalizing. This is in recent memory, so you think it could go back up here. But that was like a decent buy point. I don't know at that time what other things were in play, what news was going on, what the catalysts were. But anyway, those are some examples, and like I like the recent examples, like here's Volmageddon. XIV blew up. So VIX, this was really more VIX related, but it did impact the market. You're at 2,800, went down to 2,500. That's amazing. Look how non-volatile this was. This is like the most boring thing I've ever seen. This is, I would die if I had to show up every day like this. Boom, you have Volmageddon. Volmageddon. Pretty intense, probably not as intense as this. At the time, after like half a year of this, yeah, this is pretty crazy. So you have this. Does it get below zero? Maybe intraday. The market recovered before the VIX complex recovered, volatility complex. I guess you could take this as a buy signal, but really then the market sold off from there. So this is an example of it not working. Here you get into contango again. Okay, buy. Technically, I believe this was a bear, classified as a bear market because it was like 1 quarter. Very short-lived. But you can see, again, did this market bottom before VIX? No, these charts are not actually aligned. VIX went below zero. Boom, you're here. So yeah, it's kind of can be used in conjunction with other things as a timing signal. I don't know how to handle this, the rollover or expiration. Just COVID. Last week of February it goes over zero. So you at least have a little hint to get out or get short. If that wasn't enough of a hint for you, then you have here, it's very backwardated. Here's the peak, it reverts. You could use this reversion as a signal, but there are other examples of where it just ranges around up here. Here's like a bottom and a short squeeze. This has reverted a lot. It doesn't get below zero until here. So you've had a 600-point rally or something. But it gets below zero here. It doesn't stay there for more than a few days. Finally, here you've been below zero for a week. So it's like, do you really want to use that as an entry point when you have this? I don't know, maybe kind of a trap to fall into. But basically, if you were in COVID and you think the world's ending, and you're like, no way, I'm going to buy equities, I just saw my portfolio go down 30%, seeing VIX below zero, or the term structure below zero, can give you a heads up of like, oh wait, the world isn't ending. And then you have this. Here you have a little bit above 0. Let me search something real quick. SVB blow up. March 10th, 2023. Wait. GBP blow up. Okay, whatever. Anyway, in 2023, so the Fed pivoted, I guess, somewhere in here. Blah, 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 blah. Somewhere in here you had the Silicon Valley Bank crisis. So it wasn't much of a blip using these just two indicators, price and term structure. It was more of like a turning point of like, hey, now you buy. Like that would have been a great, oops. Here you got above 0 and it reverted. Would you want to buy there? No, that totally didn't work. Got above 0 and reverted. Decent buy. It falls back above 0. Reversion. Was this a decent buy? Yeah, this would have been fine. Here you go above 0 and you revert. This is a great buy right here. Yen carry trade blowout. And we go into the election. So this was that funny lump on the term structure. So this, in hindsight, of course, we can say this is reasonable for a buy because the term structure reverted, and you saw that with the bottom in equities. But then into October and November, you had funky stuff in the VIX anyway, so it's like, maybe you can factor that in. Election, pretty chill, market was rallying relatively. Here it's like, actually, he's serious about tariffs. Oh, Liberation Day, boom. Liberation Day was crazy volatile. You could try to use this reversion on the term structure as a bottom, or if you're really safe, you need a bunch of confirmation. Hey, has it been under 0 for a week? Yeah, okay, then you're buying up here and you've gotten this much. But yeah, so we'll get into it when we look. I mean, I guess I can look at this. Hey, here's the data mining thing. Here's the date. Here's the SPX. Here's the VIX term structure. I'll just zoom in on it really big. Here was Volmageddon. So negative is good, negative is normal. Positive means stress. You're at 28, you go down to 25, then it rallies from there. So maybe you look for a couple days of reversion in this. That could get you into trouble in different points, but here was just random bull market, or bear market, random bear market. Here you buy, would have been fine. COVID. Here is the first sign it goes positive. Here it spikes. It's elevated, nearly goes down to 0. This was the bottom. But hey, you reverted from 34 down to 0. If you had the presence of mind or you were just autistic, then yeah, you could have used that as to buy the bottom. But it doesn't go negative until April. Yeah, for me, sometimes it helps to see it in the spreadsheet instead of the chart. Also, this helps simulate, like, hey, this is the end of the day, I get this value, what would I do next? Silicon Valley. It only touched 0, it didn't even go positive. Yen carry trade blow up. Yen carry trade blow up. Barely got positive. It got positive for 3 days and then it went negative. Yeah, so it's kind of like, how do you want to use it actually? Do you want to wait till it goes down to 0? Do you want to see a mean reversion? There's various ways to use it, and the good news is we don't really have to decide now, because we'll bring in the other indicators and it will probably give us more sense and context. Anyway, I don't even know if I'm going to type any of that. I don't know, we'll decide later. So why did I even have a Jupyter notebook here? The main thing, the product that this is going to end up with, is basically a spreadsheet that shows the historical and current values of this stuff, and then it color codes it, and you can just look at the colors and be like, hey, is this about to fall off a cliff? Were we in a time of stress and it just turned? Or is it just normal and just whatever? 80% of the time it will just be like normal and whatever. But here I'll just like plot out some stuff. I'm not going to code up an algorithm in Python or anything. But there's a bunch of stuff we can do. Data. That's way big enough. Now, why is that like that? Looks better. I guess I'll just go like this. Yeah, okay, so now some just quick stuff we can do with this. Our regime SPX change change. Okay, kind of hard to see on my monitor, but yeah, so if you just, here's another way to see this. Yeah, so kind of interesting. It looks like there's just the occasional backwardation here. And then when you really look at the data, this needs to be shifted forward. Hang on. That's the problem. Okay, so this is looking at your returns for the next day when the term structure is negative versus positive, and so it's like, yeah, overall it's going to be positive, but it's more, you have fewer days and less returns. What? The mean is really high here. That's interesting. Overall, you want to stay long here and short here. The question is, if you just sum up forward, is it damn. Yeah, so here the sum is 2. And here if you subtract this from this, you get 1. So that indicates, hey, just be long only. This is some heavy rationalization here. But this is kind of like a fake Sharpe ratio. But you have to think like, hey, I would be shorting here, or I would be flat here, and I get, you know, this from being long, and I would either not get this, or I would get negative this. So you're kind of missing out actually on a reasonable return of 0.3 basis points average here. This actually seems really messed up. Does the market really only give you less than half a basis point a day? Yeah, it's like half a basis point a day. So that's also interesting here. When you sum them all up, you get half a basis point a day. When you divide them, oh, you're getting 3 basis points a day average when the regime is negative. That's way better than the average market return. So if anything, this by itself kind of shows you that it's actually great to be long only, which is buy and hold. Because you're missing out on this, missing out on this. If you were to try to trade this short, like even though you're like, hey, I'm missing out on all of this. Well, you're also missing out on this here. So far, not making a great case for ourselves. But hopefully when we get some other indicators in here, it gets better. Another one we can do, so we take the VIX TS diff, if we were to verbalize, hey, how are we getting along here? We see VIX go above 3, and then eventually it reverts by like 1 or something. It would catch you in this little whipsaw. Or maybe, hey, has VIX reverted 5 from a rolling high? Has VIX reverted 3 from a rolling high? That's how I would verbalize it. So how do we do that? VIX TS dot rolling 10 dot max. So that's a rolling max, and then we get the current value minus our max is basically, call it, you know, VIX drawdown. VIX VIX from max. That's pretty literal. Let's see what we get here. So the max value is 0. The craziest values are like 10 or something, right? Here's another way. VIX from max. So values. Dot plot. Nah. That is a VIX. VIX from max. Dot plot. Okay, that didn't help me. Anyway, yeah, we can tell, like, hey, under 2, that gives us something in here. We need less than 2, but maybe more than 10. 5, 2 to 5, somewhere in there. So we can go like this. This is kind of really drilling down quite a bit. This would give us even less examples than the sign of the term structure. VIX from max less than -3. Let's say -5 to try to prevent the overfitting. Yeah, it's giving you kind of a range of stuff to use, but it actually is giving you some reasonable points, except for this. I don't know what the fuck that is. It's Volmageddon, I guess. But basically it's giving you COVID and Liberation Day. It's not catching the yen carry trade blowout, which... Yeah, I've been looking at the combinations of these indicators, and like no single one is going to catch every one. But if you combine a couple of them, then maybe you can get something. And that's also why it's kind of nice to just use it in a discretionary way, where you're like, hey, let me look at all these colors. What's happening right now? What's the catalyst? Hey, it's the election. Here's the VIX term structure, it's whatever. Oh, it was high, then it just went negative. Maybe we're out of the woods. Wow, it's really gone negative, that's great. Toward the end of the year, it briefly went positive. Yeah, I won't talk through the whole thing, but yeah. So that's our first indicator. I don't want to go in here and just overfit everything, but hey, that gives us the yen carry trade blowout. Yay, overfitting. Overfitting worked again, except it would make you buy the top here and here. So yeah, so that kind of shows like, hey, he's more robust. Like, don't think too hard, just don't overfit. Just use VIX from the peak 5. You're going to miss the yen carry trade blowout, but it filters it down to the better times. Rely on the other indicators for additional confluence. But if you try to go lower and lower, then you're going to get some weird stuff. It'll be super noisy. It could work for intraday. But the overall idea here is like, hey, my life is super busy, stuff is going weird, I only have 4 data points a day, do I buy, sell, or do nothing? And it's like, or maybe you push an alert. You're locked in a bunker. You only get one text alert a day, and then you can buy, sell, or do nothing. You see, one or two alerts in a week. Then you're like, okay, buy, and then you go back in your bunker. That's kind of the gist of this. Yeah, I gave some examples of how to use it in Python. We'll pull it together in the dashboard later. This is kind of like a static version from a couple months ago. It has a lot of the garbage that I didn't end up using. Yeah, but that's the gist of it. Cross-asset correlation dashboard. I'll put up some notes. Eventually, once this is all wrapped up, I'll put a simple guide to it, so you don't have to listen to yapping for 1 hour. Instead, you can just read text in like 30 seconds. Anyway, cheers.